Hey there, Solar Warriors. I'm Nico Johnson, and this is Suncast. Each week, I pull back the veil on the life and business insights of clean tech entrepreneurs building the most noble and impactful companies of our time. I hope what you learn from this conversation is a catalyst for your own growth. So thanks for tuning in, and welcome to our tribe. Hey, welcome to a new week, Solar Warrior. Here we go. This is 2 for Tuesday. Whether that's a tactical Tuesday or just content from one of our many live events like SPI Podcast Lounge, this is going to be a short form conversation, typically with subject matter experts designed to give you the practical tools, tips, and advice for building your solar business or career. And grow with us here on Suncast, as I know you will. I'm so glad that you've decided to join us again and level up your game. Remember, you can always find the resources and learn more about today's guests and recommendations in the blog at mysuncast.com. So get ready to tune up your skills, Solar Warrior. Here we go with another powerful conversation on Suncast.
So Sheldon, thank you so much for taking the time to talk with me. We've been having conversations about, our first conversation about this, I want to say was about 7 years ago.
I believe it was.
Yeah, you invited me into your offices at Recurrent to tell me about this, this concept of the merchant tail and about merchant power and what an important concept this was. And I, as a journalist who came from outside of the solar industry, I don't have a power marketing background. I found this fascinating. I started to cover merchant solar projects in Chile, the Aurosolo one in Baja. I covered the disaster that happened when those Chilean plants went underwater, the scandal, the OPIC money. Ooh, boy, that was quite a story. And here we are. We're back. I didn't think about merchant power for years because I thought, it failed. It was a disaster. No one's going to do it. And now here we are, years later, and we're finding that there are shorter and shorter PPAs, particularly in Texas. The PPAs have gotten a lot shorter, and there's this new hedges coming into the market. And this is, obviously, this isn't pure merchant, but this is a move to a very different model within the solar industry. What's going on here?
So I think it helps to start by sort of grounding ourselves in a couple of things. So you and I have talked about this recently, and I just want to, sort of lay out certainly my understanding as a power marketing and finance professional on a couple of terms. So when we talk about merchant, we're talking about uncontracted power sales. So revenue that does not have a fixed price on it per megawatt hour. That could be, there's a whole lot of forms that could take, but that's pretty much it. When people talk about merchant power, they typically are talking about, it originated sort of back in the, when the gas-fired era moved from the PURPA regulations and into the exempt wholesale generators, if you will, when they redesigned the power markets for competitive power, and the merchant power model came out, where the Calpines and the AESs and the Skygens were doing assets that at first were sort of 50% hedged, right? Because you had these power markets that had huge spikes, and they would ramp to hit the spikes, and there was a lot more kind of frothy revenue, and so. That's where it came from, and eventually that got shorter and shorter and shorter because people wanted to capture more and more of these, high prices in the market. But ultimately, it is typically has a bad name in the market, merchant power, right? So that's the sort of merchant power business model. And one more definition before we start, and that is a hedge. Typically, a hedge, which comes from kind of hedge accounting in most cases, is more of a financially settled product, typically with a financial counterparty in the power markets. So a lot of banks and power trading shops, hedge funds, those kinds of guys will trade. They'll write you financial swaps, right? So they'll say you take the power at a certain point on the grid, and nobody actually physically delivers power to the bank. The bank is not actually physically using electricity. They're simply saying, we will observe the price at that node. You will pay us whatever the price is at that node as it flexes up and down, and we will pay you a fixed price. So they're just financial swaps.
Right.
So that's a hedge and a merchant definition. I think the next sort of grounding point is just the fact that, generally speaking, going fully merchant is not a good idea.
Right.
So a lot of people are just sort of really excited in solar because all of a sudden you can just build more plants and you don't need contracts. That's not actually how it works. You're taking on a spectacular amount of risk. So, increasingly, I think people need to, on the developer side, become a heck of a lot more sophisticated. And there are smart ways to take on market risk. Market and merchant, I'll sort of interlace here. I use market because merchant is a bit of a bad word in our industry.
Right.
There are smart ways to do that. You can put on shorter hedges or shorter power contracts and then manage the risk. There's things like, I won't go into what they are, but you can do things like a stack and roll. You can put revenue put tails on the back of your contract. There's a whole lot of active management strategies that people who typically take more market risk are set up to handle, right? They have a trading shop and an origination function and those sorts of things. They don't just dump it into the market. So,
yeah, and I think we're talking about two different things here. One is we're talking about merchant tails, which really is, it is merchant. You basically built a plant, you've got a PPA for a certain length, and after that PPA is up, sure, you can look for another PPA, but you don't, at the time of building, have contracted revenue past a certain point. And then we're talking about these hedges. So for me, the hedges are particularly interesting because for the entire time that I've been covering solar, you had to have a PPA. You could not build anything without a PPA. Yeah. And hedges are a price guarantee. Obviously, they set a price floor, but they're not a PPA. It's a new model. It's a big shift in the solar market.
For sure. And I think and I don't want to be the guy who's sort of the downer here, but I think the other misunderstanding that folks in the solar industry really need to understand is, just because there is a new set of buyers in the market, which is really where kind of the hedge concept comes from. Again, banks buying financially, typically hedging. What you're seeing people sort of maybe on a misnomer basis sort of equating with hedges, and some of them are hedges, are buyers like the big commodity shops, big oil and gas companies, big hedge funds, big industrials with huge loads, right? Those guys are doing hedges, or in many cases, they're actually taking it physical though, so it actually is just an offtake contract.
Right.
But those are the family of people doing these shorter term contracts, right? I think the thing to understand though is that people sort of see it as, well, again, I don't have to bid. I don't have to go get a PPA. I don't have to do, slit my own throat to go get
sell the power,
a CCA
right,
to try and buy my power for, with no credit rating. I think what you have to understand is that it's not just the PPA store, right?
You still have to go shop and get that hedge.
That's right, and
there's not an infinite amount of them available. Clearly,
totally, and the guys that are doing those are very sophisticated, and the two things to point out really are, you have to speak their language, and I don't think a lot of people in the solar business do, particularly not a lot of smaller independent developers. So you see them doing business with a lot of the EDFs and other folks, that they're normally doing business with, because they already do, Brookfields, people who've been in wind or gas or other places where they've always been doing, or where they've more recently been doing hedge type transactions. The second piece is just that one of the other reasons why a lot of small independents are there's a lot of hype about that market, but they're not able to jump into it, is it requires an enormous amount of credit. Right, and so you either need to put, you're taking huge financial and commodity positions, right? And so you have to deal with, banks will look at the duration of the contract, they will look at the volatility in the market, and they will price credit based on what, statistically, what the maximum loss could be, right? And so the longer, your tenor goes out, the bigger that credit balloons. Because you could deviate this way, you could deviate that way. Statistically, there's more risk, and so you get a lot of, for instance, I'll tell you that on a 200 to 250 megawatt sort of hedge type transaction with a commodity player or a bank, you're probably talking about $35 to $50 million of credit, of an LC at execution. And then you have to be able to either continue to post that and be able to actually margin as the market moves during operations sometimes, or you can transition that to a lien on the asset. But then to do the lien on the asset, you have to have the off-taker and the tax equity and the debt all negotiate together for, so it's a tremendously complicated access to the market has a very high bar,
right,
which I think is a good thing. I mean, I think, we're at a point where...
Don't necessarily want just anyone.
Yeah, I mean, solar is becoming a business like any other, where you really do have to, on the developer side, you have to understand deep nuances of the power markets and the financial markets and how they overlay in order to be successful. And what's interesting is on the investor side, that's true as well, right?
Right,
so,
right. And at the same time, I think all of this is happening within a larger environment. When we first started writing about solar, it was very difficult to find investors. People were really looking for money. And now, the interesting thing is I've watched this evolution. I've watched solar companies create these yield cos, investors invest in them, solar companies routinely just sell off their yield cos, sell them off to big asset managers. So the big asset managers are seeing these obviously as something valuable to pick up. And then at this point, we're seeing the wall of money. We're seeing all of these investors who would like to get into the predictable returns of solar. And so I'm wondering how much that interest by the financial community in investing in solar is driving some of these alternative models to offtake, or rather this alternative model to offtake.
For sure. I mean, there's no doubt that it is, because developers have in their mind that there is an unlimited appetite for projects. And so you have seen a lot of developers do very well. But I think a handful of things on the investor community. One, we spent the last decade basically building a market of people who want to buy bonds. And inside our shop, we call it the green bond, right? A contract of 15 years or better. It started at kind of 25, then it came to 20, now it's 15. And you've got a lot of investors who, through that transition, they just kind of kept squinting as it got shorter and shorter and been like, well, if you kind of look at it, it's a long-term contract, right? And they go in and they invest on, kind of bond-like returns, right? I mean, in the beginning of solar, when you got a 25-year RPS contract from SCE, you literally went in, you tacked on 25, 50 basis points of premium for the operating yield, for the operational risk, and you were otherwise just issuing an SCE bond, right? So you had a bunch of people show up to buy SCE bonds. And, the analogy I use is it's like a treasury auction, right? In a treasury auction, you don't have a bunch of people evaluating the business model of the U.S. Treasury to try to understand what the risk is, right? They show up, they know what the risk is, it's the risk-free rate, and they just bid their cost of capital, right? And so we've been having treasury auctions in solar for the better part of 10 years now. And, the problem now is that there's no more product left, right? The PPAs, the compliance-based PPAs that were longer tenor, RPS type stuff is going away. And increasingly you have to participate in the energy market like any other generator.
Right.
And as you do that, that's where these shorter tenor contracts are coming from. But there's a tremendous mismatch between the buyer community that we've built up over the last decade and where we're going. And so what's really interesting to me, and I think will define the future of the solar industry, is we are seeing a rotation of the types of buyers who will own solar plants. They are moving to a much more sophisticated group. They're moving away from sort of pension funds. Not that those guys aren't sophisticated, but those are long-term yield buyers. We're moving away from those folks. We're moving much more back to, you'll see a lot more private equity power funds get involved. As the returns move from sort of what at their crushingly lowest point when everybody was showing up for the treasury auction was 6 on levered. We joked about the levered sevens, right? Things were clearing in the levered sevens. That's absurdly low, and what you'll see now is people moving in. That group of buyers, as the tenors came in, they lost the ability to squint and sort of equate 15 years with 25 because they realized they were taking more and more back-end merchant or market risk. And so those guys are now getting gun shy on this new class of assets, and you're seeing these guys who usually buy power assets, wind, gas with shorter tenor contracts, that trade in the 9 unlevered, call it high single digits unlevered, low double digits levered. Those guys are coming in now and they're saying, why would I buy a partially merchant gas plant in PJM? Well, PJM's a bad example, but in another market, which may or may not, maybe shut down for carbon or something later, when I can buy a similar yielding, solar asset with a similar, contractual tenor and market exposure.
Hey, Warrior. In this fast-paced change of renewables, what inverter company can you really count on these days? Well, how about CPS America with its 99% inverter availability guarantee? That's right, you can get 5 to 25 year uptime guaranteed by CPS, and CPS has a turnkey field service with both preventative and corrective maintenance, and service plans tuned to meet the needs of asset owners and O&M providers alike. If you'd like to find out more about what CPS can do for your C&I and utility business, head to mysuncast.com/CPS. Hey, are you losing commercial solar sales because of high demand charges that minimize the ROI for your customer? Extensible Energy's Demand X software is an affordable new solution for reducing peak demand charges by 30%. No batteries required. Extensible's intelligent software analyzes solar production, utility rates, weather data, and more. Then it crunches that data, monitors solar and flexible loads, and automatically reduces peak demand spikes, increasing your customers' ROI and decreasing payback time. Head to extensibleenergy.com/Suncast for a free demand charge analysis for your project and to learn more about Extensible's partner program for commercial solar installers. You can learn more at extensibleenergy.com/Suncast.
So, to get to this merchant tail, which is the first thing that we discussed 7 years ago. So I recall First Solar's Berea project in Texas. It was a merchant project. They built it on a merchant basis. They were always looking for a PPA, but they just said, hey, let's give this a try. And they lost a lot of money on it. And then they got a PPA. And I found that interesting, given that it seems like if you could do this anywhere, you could do it in ERCOT. Given the intense need for power in the summer, the really high caps on how expensive power can get. It's almost a pure market there. Yep. And yet it didn't seem to make money. And now, here we are, a few years later, these 10-year contracts. What happens after that 10 years? Are these assets going to be able to find another contract, or are they just simply going to say, hey, we've paid off our debt, we've made some money on this, we're going to make the rest on the market?
Yeah, I think a lot. The smart folks will roll forward their contracts years at a time, right? You'll see people beginning to put on volumes for 2 years beyond the contract tenor. So if you got a 10-year contract, by year 5, you're able to sort of address a fairly liquid market. It's not liquid, but years 5 through 8, people will transact with you for that, and you start managing your risk forward. Maybe you put a put option on it, and then eventually you roll out to a swap at a nice time when you can get a nice high price. I think again, going fully merchant is not really a business. Hope is not a strategy, right? I think the thing to realize is this: like, if I'm a buyer right now and I'm looking at these assets, right? And the big question is, what happens when I get to the end, right? What I'm going to look and say is, I could go buy the same asset in Texas, right? I could go buy the same asset with a 10-year PPA on it or a 15-year PPA on it, right? And I'm just going to tell you about how, if I'm a buyer and what I think smart buyers are thinking about back-end risk. If I go buy a 10-year PPA right now, or not a PPA, but a hedge or something in the open market where I don't have to, I can actually probably get a price that's in the upper 20s. Maybe a little lower because ERCOT's come off a bit. Let's call it mid-20s on a 10-year deal. Now, the reason that's a premium is because you have to have credit and sophistication and access to the banks and all of that. But you can get a market price, and then, or I can go and get a 15-year deal by slitting my throat for Austin Energy, and and I'm not taking away from those guys. I'd be buying just like they are, but and maybe that deal's $19, right? Mm-hmm. So the interesting thing is, if I'm a buyer and I look at that, the 15-year deal is being overpriced, if you will. People are overpaying for that tenor. And so if you discount that at where that deal might be trading, call it like 7 levered, and you discount the shorter tenor contract at where that will trade is maybe like in the 9s unlevered. What you actually find is that because of the higher price, you oftentimes find that the present value of the actual contracted revenue on both of those projects as a percentage of the total revenue is not that different because you're getting such a higher price on the shorter tenor contract.
Sure.
And
so that's what you need for financing.
Yeah.
I mean, you need that guaranteed amount of revenue. It doesn't matter what period it comes over.
Absolutely.
So if you have that portion, you still have that same access to financing. And yet it seems like people who are financing solar projects are getting comfortable taking more and more risk.
That's true. I mean, like those banks have been taking that risk in other markets for a long time. I mean, at Calpine, people have always financed a portion of the merchant tail, right? There's a contract period, and then and some of that has to do with what we call the quasi-contracted price, which is what I think people need to start getting used to in the marketplace, which is, as contracts were long and then started shorting up, everybody sort of fixated on these metrics that frankly were really not very financially sophisticated and kind of arbitrary, like contracted period return. Okay, well, that's an interesting thing if you've got a 20-year contract or you've got a standard length. But as contracts come in on tenor, it turns out to be kind of a useless metric, because if my contracted period return on a 10-year deal versus a 20-year deal, of course it's going to be less, but you also now have 10 more years of power that you're selling, right?
Yeah,
so
definitely.
we work with this concept of like quasi-contracted, where we look at, if I'm a buyer, I'd much rather take a $27 contract for 10 years and then get comfortable that essentially, look, if power's trading at $20 right now or 22 or whatever, you've got to believe that an electron from year 10 to 20 is going to be worth $10, right? And so there's this notion of kind of like almost a quasi put to the market where it's like it just can't get lower than X. There's a portion of merchant risk you are willing to underwrite. And I think both equity is beginning to look at it that way, right? Which is, can I get my money back on the contract? Can I get my money back on the higher price, shorter tenor contract, plus some ridiculously low assumption of like, how bad does it need to get?
How bad can it get?
And that's what debt's been doing for a long time now. And that's how they underwrite kind of a merchant tail, right? Because it can get ridiculously bad before they get, harmed.
Well, and yet it's funny, when we think about that, when we think about power prices into the future, which is obviously extremely speculative, I can't help but notice that there's going to be a huge difference between straight solar and solar plus storage. For straight solar, the more solar that we add to a grid, the more the midday price depresses. So perhaps some very pessimistic future price assumptions are reasonable if you're talking about a whole lot of solar. But with solar plus storage, you can sell that any point over a 24-hour period.
Yeah, there's no doubt. I mean, when you
such a different animal. How do you deal with how completely different those are when thinking about long-term?
First of all, I think most people are kind of thinking about storage wrong. I mean, there's niche markets where you can do more bespoke products. There's places where you can pick up subsidies, and those will be great, and that'll grow the technology in that. But I mean, the holy grail is like, here's a 7x16 shape, like a block product that trades in a liquid market, and here's a solar shape, which is typically like a 12x24, right? And when the price of those two things, the spreads in the markets and commodity markets right now are, 5 to 10 to in California sometimes because of the duck curve, $15-20, right? And that right there is the value of storage, right? Because anything that can turn a 12x24 shape into a 7x16 block, that's the value of storage. And so I think what you're going to see is you don't necessarily need to go full 7x16. I think you'll see people signing up 7x16 with maybe 2 hours of battery storage, and you'll see them pushing the size, the overbuild on the solar. They'll clip more. They'll square off the shoulders. They'll put 2 hours of storage because the duration is what's expensive, and they'll start selling 7x16 blocks where they take a little more open risk, but at reasonable times. The other thing to say on this is, welcome to the power markets, to all the investors and banks, right? I mean, like the reality is, and most of them are very sophisticated and can take this on, but but now you have to think, right? And so I'm kind of tired of having to explain over and over and over again why ERCOT is not California, right? ERCOT has some of the highest penetration of wind in the country, and so as we build out solar, and the load shape tends to be hugely cooling based, right? So you've got a huge peak coincidence with solar
potential
shape
in the summer.
And so huge peak coincidence with solar shape, wind that blows in the off-peak periods that is right now just dumping a lot of the time, right? And so that blocks out actually. Like you've got much more room to build before you hit probably a duck curve in Texas. It's a much more robust market to the duck curve. And in addition to all of that, a lot of these guys are getting whipsawed and caught on wind, and they think, oh my God, it's going to happen again in solar because these shorter tenor hedges with like fixed shapes essentially that are wind shapes. So they go hedge like a wind shape of output, right? Mm-hmm. But the problem then is, and it's a fixed shape, but the problem then is when it gets really hot and a lot of times the wind doesn't blow, now they've got to deliver, into these $9,000 price spike hours, and they're short. They're not generating, right? And so their shape risk is actually negatively correlated with value, right? It's a negative valuation in ERCOT. Whereas, so they're mismatched. They're mismatched between their actual generation profile and the shape they have to put into most of their offtake contracts leaves them exposed at the worst possible time. Solar shapes, on the other hand, you're actually typically going to be relative to the shape of your off-taker contract that you're getting paid on. The generation is likely to be over-generated in the hours where the price spikes occur.
Right.
So actually what's killing wind is actually going to make fixed price or fixed shape, like hedge type arrangements in Texas, better for solar.
Sure. And I think this basically comes down to when does it produce? And solar's got a tremendous advantage. I've been waiting for ERCOT to blow up like this. We've seen it coming for a long time. So quickly, we're going to have to go soon and move on to the next guest, but we covered your company, Intersect Power, some new developments that you've announced this week, 1.7 gigawatts of power contracts for projects scheduled to start construction within the next 13 months.
Yeah.
That's remarkable. Yeah. In Texas and California.
We 3 physical sites, 5 different legal entity, 5 different projects, 2 pairs of sister projects that if taken together, would be in the top 5 by scale, for scale in North America. So, going into Intersect, really focused on taking the lessons learned from Recurrent Energy and redeploying those. At Recurrent, we were never quite as big as the SunEds or the Cypresses of the world, but, we got over 200 people at a certain point. And what you learn is that, when you're big, you've got overhead, so you go chase the portfolio of 5 megawatt deals, 5 megawatt carports in upstate New York, and then those are really hard, so you have to add more people, so you have to chase more carports, right? So our model is, our model is small team, big projects, very few of them. So we did all that in just over 24 months with $25 million of equity and a 20-person team.
Wow.
So pound for pound. I'm incredibly proud of our team and what we've been able to accomplish. And we had a lot of fun. We've had a lot of fun doing it, and we're gonna, we got a lot more where that came from. So. And
some of the shortest contracts I've seen, a 10-year contract in there.
Yeah, there's a 10-year contract in there, but I mean, not to overblow it, because what we did was we sort of dipped our toe in the water, right? I mean, the average contract life on that portfolio is 12 and a half years or something like that. So it's not tremendously
compared to 2 or 3 years ago. It's
yeah.
not tremendously different than what we're seeing in contracts right now, but compared to 2 or 3 years ago, this is still huge.
Yeah.
And I had not actually seen a 10-year before this. I'd heard about them, but I never actually identified a project that had only a 10-year contract.
Well, at the same time, though, we're doing some more sophisticated things. Again, you can't just kind of keep shortening it up and kind of, we're doing things on the California project where, we split RECs and power. And so for the first, 8 to 10 years of the contracts, we're getting $30 prices all in, where if you go out and you don't have the sophistication to split those up and go get a hedge in the energy markets, you don't have the credit to do that. You really have no choice but to bid bundled product to CCAs, bundled Rex and Power for the low 20s. So, there are ways to make a lot more money. It's just much harder.
Right. Much more complex. Sheldon, thank you so much for taking the time to talk with me. It's been a real pleasure.
Thank you.
All right. We're here at the Podcast Lounge, sponsored by Radiant REIT and produced by Suncast Media. This is Christian Roseland, U.S. editor at PV Magazine, and I've been speaking with Sheldon Kimber.
All right, that's a wrap on today's conversation, Solar Warriors, but I do hope that you'll check out the other 2 for Tuesday episodes and let me know what you think of these shorter format discussions. You want more like this? You can find more than 200 episodes, resources, highlights from the discussions, along with social media links to each guest episode, book recommendations, and so much more over on the blog at mysuncast.com. And that's also where you'll find other ways to engage with the Suncast tribe, like subscribing to our weekly emails, or even joining the exclusive inner circle we affectionately refer to as the Guild. If you're on Spotify or iTunes, I so appreciate your rating and review so that others can also find Suncast more easily. A special thank you to our sponsors who help make this podcast possible. You can learn more about them at mysuncast.com/sponsor. Follow the links there for any offers we've discussed here today. Remember, you are what you listen to. Thanks again for showing up, Solar Warrior. It's half the battle.